The performance of Bitcoin in 2024 has been remarkably impressive thus far, alongside the continuous surge of broad stock market ETFs to new all-time highs. This has undoubtedly made it an exhilarating year for investors. However, the question arises, can Bitcoin continue to outpace my predominant investment, which comprises passive low-cost ETFs? Let's delve into that. Additionally, we'll scrutinize the performance of my various investments, including ETFs, peer-to-peer lending, and cryptocurrency, throughout February, as well as any significant events up to March 2nd. Lastly, we'll assess whether I've adhered to my October 10th 80 investment strategy amidst the current market conditions. Starting with the cornerstone of our investment portfolio, low-cost ETFs. These ETFs are integral to our early retirement strategy and represent our long-term conviction investments. In February, the stock market rally persisted, with our primary ETF, the Vanguard FTSE Global All Cap Index Fund, concluding the month with a 4.3% gain, bringing its 2024 performance to 6.98%. In terms of figures, our gains exceeded 1,600 euros last month alone, and 21,100 euros since the beginning of the year. Notably, the S&P 500 index performance has been remarkable, experiencing a trend not witnessed since 1971, with gains in 16 out of the last 18 weeks. While this might suggest a looming market correction, attempting to time the market is ill-advised. Therefore, my wife and I will continue our monthly contributions to the accumulating Vanguard FTSE Global All Cap Index Fund through cost averaging. While I anticipate further gains by year-end, the journey might not be as straightforward as the recent month's upward trajectory. Trade Republic, one of our primary brokers, also functions as a high-yield savings account, offering a 4% annual interest rate secured by a 100,000 euros bank deposit guarantee. In February, we accrued 61.80 euros in interest on our savings there. Now, shifting focus to cryptocurrency, particularly Bitcoin and Ethereum, which have witnessed extraordinary price surges lately, making them more compelling subjects compared to developments in the peer-to-peer lending domain. Bitcoin saw a remarkable 44% increase in February, translating to a staggering 49% year-to-date performance, while Ethereum fared even better with a 46% surge in February and 52% thus far in 2024. This surge indicates a crypto bull market, largely fueled by institutional involvement. Notably, there has been relatively limited interest from friends and family in Bitcoin compared to previous rallies, and Google Trends data indicates a gradual uptick in interest. However, it's important to note that cryptocurrencies remain highly speculative and carry significant risk, and I don't intend for them to become the primary focus of this channel. Therefore, it's advisable to allocate only a small portion of your investments to cryptocurrencies, if you choose to include them at all. However, I want to acknowledge that our modest investment in crypto has significantly augmented our investment returns since 2017, with our current gains averaging over 440% on Bitcoin and over 250% on Ethereum. I apologize for not disclosing the specific amounts of each investment here, as I typically do with my other investments. The reason being, sharing precise cryptocurrency holdings poses a security risk, so it's prudent to avoid sending screenshots of your holdings, for instance. Nonetheless, we've managed to recoup our initial investments several times over since 2017, for which I'm immensely grateful. Nevertheless, it's crucial to recognize that cryptocurrencies remain highly volatile assets, susceptible to rapid declines as much as they are to rapid gains. Therefore, regularly rebalancing your portfolio to maintain a reasonable allocation to cryptocurrencies is advisable. Despite their stellar performance, I refrain from making cryptocurrencies the predominant position in my portfolio. Instead, they serve as a speculative bet on the future and are accordingly allocated a smaller portion compared to our core investment in broad-based low-cost ETFs like the Vanguard FTSE Global All Cap Index Fund, which constitute about 80% of our portfolio. This allocation reflects our unwavering confidence in stocks as a long-term asset class. Regarding our investment strategy, while our original October 10th 80 allocation plan has evolved to more of an 80% ETF, and 20% crypto investment strategy over the past 2 months. This adjustment is partly due to changes in interest rates and loan availability in peer-to-peer lending platforms. However, it's worth noting that attempting to time the market for Bitcoin can be challenging. Historical data illustrates that buying and holding, coupled with regular cost averaging, has proven to be a prudent strategy for Bitcoin investors thus far. Nevertheless, investors should be prepared to weather regular corrections of 20% to 30%, even within a bull market, as this asset class demands resilience. For secure purchase and storage of Bitcoin and Ethereum, I rely on Bitvavo, a Netherlands-based low-cost exchange renowned for facilitating crypto transactions in euros. Bitvavo boasts numerous security features, including two-factor authentication, essential for account security. Additionally, they offer substantial insurance coverage and account guarantees in case of unauthorized access. I recently made purchases of Euro 750 worth of Bitcoin and Euro 750 of Ethereum through Bitvavo on February 24th. Despite the security measures provided by exchanges like Bitvavo, it's advisable to transfer the majority of your crypto holdings to a hardware wallet for maximum security, especially if the value exceeds a few thousand euros. Currently, I favor the Trezor Model T as my primary hardware wallet, although the Ledger is also a reliable option. It's imperative to acquire these devices from official sources and maintain an offline backup of your seed phrase to ensure access to your funds in the event of hardware failure. Now, let's turn our attention to my investments in peer-to-peer lending, constituting approximately 10% of our portfolio. February proved to be a lucrative month in terms of income, with a total of €380.78 earned in interest across the 7 platforms where I'm actively invested. Here's the current distribution of my funds among these platforms in percentage terms. Firstly, let's discuss MOS. Despite earning over €65 in February, the impact of decreasing interest rates among its top-rated lending companies is becoming more pronounced. Transitioning to income, while earnings amounted to €59, I found the persistent cash drag bothersome. Consequently, I withdrew €500 mid-month, redirecting it to Estate Guru and Bulk Invest. Although Income introduced a new lending company, Current Auto, offering car rentals, the modest interest rate of 10%, and the company's current lack of profitability make it less appealing compared to other opportunities on the platform. Nonetheless, the expansion of lending options is a positive development for investors. Moving on to Estate Guru, which experienced an outstanding month with €70 in interest payments. I supplemented my investment with an additional €250 in mid-February. Similarly, Bulk Invest yielded over €61 in earnings, marking my most successful month on the platform thus far. I reinvested the remaining €250 withdrawn from Income into this account on February 19th. Meanwhile, RoboCash saw no cash drag, maintaining its smooth operation. At Lendy, focused on secured agricultural loans, I received over €55 in interest payments, buoyed by the full repayment of 3 loans. Lastly, Debitum continued its reliable performance, with all loan payments being timely. The platform rebranded from Debitum Network to Debitum Investments at the end of February, signaling its intention to diversify its offerings beyond loan investments. Summing up my investment overview, this year has been unexpectedly dynamic, and I hold a positive outlook for the remaining months. However, investors should brace themselves for market fluctuations, including potential downturns. Consistent cost averaging, maintained over 7 years, remains a prudent strategy regardless of short-term market movements. I'm eager to hear your thoughts. Do you believe a modest allocation to Bitcoin, alongside ETFs, remains justified based on its 15-year track record? Or do you anticipate its outperformance to plateau? Share your opinions in the comments below, and exercise caution against scammers and impersonators who often appear in discussions on such topics.